Today we're going to talk about how long-term investing can have a profound impact on your portfolio. We're going to talk about the importance of time in the market, not timing the market. Even when emotions get the best of us, even when on the news channel, whatever it is that we're tuning into, we see worries about maybe an AI bubble or a market crash, or these all-time highs can no longer be achieved. And while that's interesting, it's important to zoom out and take an unbiased approach on what we mean by long-term investing. So let's go to this chart here. On this chart, we can see the S&P 500 gains from 1950 to 2024. And what we're looking at here is the probability of S&P 500 gains between this time period. And we can see here that if we were invested for 1 year, if we put our money into the market, we have a 74% probability of being positive. Now, over a 3-year period, we see that it's an 85%. Over a 5-year period, we see it's an 84%. Over a 10-year period, a 92%. And over a 15-year period, 100% probability. And now I'm not saying that past performance is indicative of what will happen in the future. But what we're looking at here is, again, the importance of long-term investing, especially if you're investing for goals like retirement. And so now this brings us in to our next graph that we have here. And what you're looking at is the annualized performance between 1990 and 2024. And we're looking at the S&P 500 specifically. That is the S&P 500 indexed annualized performance. It is important to note that indexes are unmanaged and cannot be directly invested in, but this will serve the purpose for the point that I'm trying to address here. We can see here that if you were fully invested, you weren't changing investments from 1990 to 2024, you did about 9.8% per year in the S&P 500. If you missed just the best day in a given year in this time period, that 9.8% dropped to 6.1%. If you missed just the 2 best days in a given year, you went from 9.8 to 3%. So the idea here is, the importance of staying invested for the long term, of not trying to time the market. If I pull up another PDF here, this PDF is titled, How Long Does It Take for Your Money to Double? But more specifically, what I'm looking at is the average annual returns from 1928 to 2022. And what we see here is for the 3-month T-bill, it did about 3.3%. For real estate, it did about 4.4%. For the US T-bond, it did about 4.9%. For gold, 6.5%. Corporate bonds, 7%. And the S&P 500, 11.5%. Since 1928, the S&P 500 has seen double-digit returns almost 60% of the time. Again, if we look at our previous graph here, we know that, the probability of S&P 500 gains in a given year is a 74% chance. And so the point I'm trying to drive home here is, look, staying invested has a profound impact on your portfolio. Look at this 9.8% versus 3% difference if you just missed the 2 best days. What's important to note is we need to consider inflation. We should also consider things like other investments, the 3-month T-bill. If we go back to the PDF titled, How Long Does It Take for Your Money to Double? We see here that the 3-month T-bill averaged 3.3% from 1928 to 2022. If we go to the annualized performance between 1990 and 2024, again, it is a different timestamp, but the point I think is still credible here. We see that if we missed just the best 2 days, we went from a 9.8% to a 3%. Guys, we are lagging the returns of bonds. We are lagging the returns of T-bills over a long period of time. And let's not forget about inflation. From 1928 to 2022, inflation averaged at about 3%. So if we look at these numbers on an inflation-adjusted basis, our 3-month T-bill went from 3.3% to 3%. Real estate from 4.4% to 1.4%. The US T-bond from 4.9% to 1.9%. Gold from 6.5% to 3.5%. Corporate bonds from 7% to 4%. And the S&P 500 from 11.5% to 8.5%. The last point I want to highlight here is the history of US bear and bull markets, looking at daily returns dating back to 1942. And so now for the final point here, I want to look at the history of the US bear and bull markets dating back to 1942. If we look at this piece here by First Trust, we can see that the average bull market period lasted 4.4 years with an average cumulative return of 155.7%, whereas the average bear market period lasted 11.5 months with an average cumulative loss of 30.9%. As I highlighted at the beginning of this video, staying invested for the long term, looking at time in the market rather than timing the market can clearly have a profound impact on your portfolio over a long period of time. If you're wondering, after watching this video, what does my allocation look like? Is my portfolio composed in such a way where it's helping me achieve my short and long-term goals? Then I invite you to reach out to us today. Our information's at the end of this video, and as always, thank you so much for tuning in. I hope you have a wonderful rest of your day. Bye-bye.